Welcome back to another episode of Not Financial Advice. My name is Sean. Today is Saturday, April 6th. And on today's episode, we're going to be talking about Penske stock. So that's the trucking and car rental company, 10 PE company that has absolutely smoked the S&P 500 over the last 5, 10 plus years. By the end of today's video, you're going to get an idea of what a fair value estimate is on Penske stock and whether I think it's going to be a buy, hold, or sell. We're going to dive into that right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Everybody, I want to start with a couple of questions. What if I told you that the best investments surrounded you every day as you went to work, as you walked around, as you shopped, as you got on your laptop? What if I told you that by just opening your eyes, putting your ear to the ground, you can find investments that can make you 20, 40% a year? What if I told you that you're able to do this just as well as Wall Street? And what if I told you that a company that's returned 40% a year over the last 4 or 5 years could just be the one that you're working at? Those are the questions that we're going to answer today as we take a look at Penske stock. It's a true life story, and let's get started so we can give you these answers. First, we'll do an update on the portfolio, how it's been going recently. I'll ask you to like the video, subscribe to the channel, comment down below, maybe where you work at, if you work at a company that's publicly traded, or if you have any experience with Penske or you own the stock. Let me know in the comments down below, and make sure that you're subscribed so you can follow the channel for more compelling stock ideas you won't find anywhere else. So today, looking at my entire portfolio, it is the weekend. On Friday, I was up 105%, or 100.05% rather. The market on that day was up about 1.2%. So looking over all time, my best three performers are the total U.S. stock market through Fidelity, Amazon, and Williams-Sonoma, with gains here, here, and here. So we're going to be talking about Penske stock today. Let's jump right into it. So as you can see here, that is a majestic looking stock chart. Okay. Looking just over the last 5 years, we can see where this thing really took off. And this is the COVID meme crisis boom. So since the bottom, this stock has returned 594%. It's returned over the last 5 years about 233%. So what is that per year? Right. So 44.6% on a boring 10 PE stock. Let's learn a little bit more about this company. So Penske Automotive Group, we're going to be taking a look at its financial performance and some important metrics over here on Qualtrim, not a company that I'm affiliated, but a software service that I pay for. I'll leave a link for Qualtrim in the description below. Highly recommend it. So what I'll say is this: if you're not familiar with Penske, they rent out commercial trucks and repair them, and I also believe that they have a rental fleet of consumer vehicles. And so the concept on this stock is, what can we do to have a play on people wanting to go on vacations? If the economy remains good as it is, what do we do to capitalize from people renting cars to go on vacations? And what do we do to benefit from, some of the industrial tailwinds that the U.S. market has from the CHIPS Act, from the need for CapEx to build out AI facilities, things of that nature? How do we benefit from that? The Inflation Reduction Act, different infrastructure bills that have been passed. And so Penske Auto Group, it's considered a consumer cyclical truck rental. I feel that it also should be viewed as an industrial to an extent, at least from the level at which I'm familiar with it. But as you can see here, it's a 10.4 PE value stock, and there's a massive free cash flow yield of 10% just at this moment. And so they're also a dividend payer, almost 1.9%, and it's only 20% payout ratio, meaning the dividend is sustainable and likely to grow over time. faster than the rate of inflation. So let's get into some checks and minuses on this company, and we're going to start answering those questions that I posed to you at the beginning of the video. I'll ask you to like the video, subscribe to the channel, and let's take a peek here at Penske revenue. So over the last 10 years, it's up over 7% a year. That's a really good number, so it earns a check mark from me, a thumbs up on top line revenue growth. Let's also take a look at free cash flow. So this is a little bit of a weird looking chart. I had to pull data from Yahoo Finance. This company is a little bit weird. I believe this represents just one quarter. So if we look, if we look from here to here, or from here to here, we can see generally that this is in fact up into the right. I don't believe this is going to be a forward trend of its performance. Could be, but I just don't see it. And so I'll give it a thumbs up on this rating. But let's move forward a little bit. One other thing I'll say, if we just look at this, I'm seeing free cat fleet. I'm seeing free cash flow growth that's like from 2020 to 2018 or so, something in the 50% range. So recently, it's been absolutely nuts, and we're going to use that in our modeling. So additionally, when we look at earnings per share, another thing that can certainly drive stock price, you've got earnings per share over the last 10 years in the high teens range, nearly 20%. And that's accelerated over the last 5 years. Big thumbs up on earnings per share. I don't understand why this company is so cheap. Let's keep looking. So we're going to take a look at cash and debt. Now, I pulled this data from somewhere else. I think there might be a little bit of a glitch here on Qualtrim, but you'll see the cash and debt here at the end, and it's very reasonable, fairly capital light business. So they get a thumbs up. But looking at dividends, it looks like, with the exception of the end of the great financial crisis, looks like they've cut dividends once, like 15 plus years ago. But this looks like a really safe dividend play. Dividends are increasing at a rate of 17% a year over the last 10 years, trouncing inflation. Huge, awesome dividend growth story here with Penske. I'm really excited about this one, you guys. So looking at shares outstanding, let's take a look and see how Penske's doing on not diluting shareholders. So in a recession, it looks like, in the past during a recession, they didn't have an issue diluting shareholders. That could be a huge risk for this stock. But it looks like in more recent history, really the last 20 years, they've been a net repurchaser of shares. So it's under the same leadership, I think, where the owner, the founder is still around. He's getting a little bit older. I'm not sure what the new management is going to be like. I have to just sort of give this a neutral rating. There is some risk here, to be honest. So let's move forward. Looking at ratios, return on invested capital, let's just look over the last 10 years. We can see this holding pretty steady right around this 14% mark. And so that's about average, a little bit better than average. So I'll give it a modest thumbs up on that. But also importantly, now we can see a nice story here with their margins expanding, from 2% to 3.5%. And so although that number is low, it is moving up into the right. And so I'll give that a mild thumbs up. Let's last take a look at expenses and see what we can see here. So we can see here, $380 million of CapEx for a trucking and vehicle company. That's quite low. This is, I can guarantee you, better than holding Ford or GM, not financial advice. But let's keep on pushing and see what else we can find out here. So very, very cool stuff. I think it's important to sort of get an understanding of who these guys are, just in case you don't know. But Penske is a diversified transportation service company, automotive and commercial truck dealerships, four segments: retail, automotive. So I think they have used car lots, good margins compared to new, retail, commercial trucks, other, and non-automobile investments. It operates its dealerships under franchise agreements, various automotive manufacturers and distributors. Company engages in the sale of new and used motor vehicles, and related products and services comprise vehicle and collision repair. So, yeah. Now, one thing that's also important to know, they have 146 locations in the US, but they have 174 outside the US, and they're in some really nice markets. So we see the US, the UK, and I believe they also have some stuff over in Australia, New Zealand, and Japan as well. So really good markets that they're in. let's keep on pushing here. Like the video, subscribe to the channel, and let's take a quick look at the investor presentation deck Penske put up. So, automotive retail locations, US, UK, Germany, Italy, Spain, and Japan. I really like that. Um, they have some special business in Australia and New Zealand. Now, they also own 30% of Penske Transportation Solutions. So, not all of the Penske brand is under this ticker symbol, but that seems like there is exposure to everything. And then they have used car lots in the US and UK, as well as commercial truck locations in the US and Canada. And I definitely like Canada, heavy on materials. And so industrial there should be pretty strong and safe. So overall, we could just sort of scan through this. Anything that jumps out to me, I'll kind of call out. I think we're kind of covering it. I think we have a good idea. I think we have a good idea of what we're looking at. Let's let's go through these slides. So yeah, um, looks like just a pretty competent company, a company that does a good job on producing financial information for investors. And so a big name, really diversified, not a very mature company. So I don't think we need to get too far deep into that, but I do want to bring you into something we're going to start doing a little bit more, maybe looking at technicals on Penske. And so here in red is a 200-day moving average. In yellow is going to be your 50-day moving average. And then in green, you're going to have your 20-day moving average. And so with the 50 day moving average in yellow being above the 200 moving day average in red, that should be a long-term bullish indicator. The 25 and the 50 being so close and looking like it could cross over could be a short to midterm bearish indicator. But the overall trend here definitely looks bullish. And if we just jump back and look at this stock, this looks definitely like a power stock, one that keeps on going up, down 13%. Is that a good time to enter it? We're going to find out. So, we've gone over everything. What we're going to do now is take a look at the fair value estimate of this stock. It's trading for $153. Now, just to be safe and transparent, I wanted to see if there was anyone who was a professional, which I am not, that has an estimate on the value of this company. So we didn't come up with the same numbers, but I see the stock at $153. They raised their fair value estimate from 130 to 142, and so they're showing it as about fair valued. We have a $153 stock. Let's get over here using the assumptions from Qualtrum and see what numbers I came up with. So these are the numbers I came up with. I did pull data from Yahoo Finance this time. So this is going to be free cash flow over the last 5 years. It's not stock-based compensation adjusted, so we should have a little bit of a. They don't. They're moderate issuers of shares. They don't seem to have a pattern of abusing it, although last year was high. Just something to keep a note. But cash on hand, 96 million. Debt is 1.4 billion. Not the best, not the worst. Now, shares outstanding, it's at 67.2 million. And I've put in a growth rate of 5%, 4%, and 3% with a discount rate of 10%. Now, here's why. This is a very mature company. It's also cyclical. And so its earnings can be less predictable. And so in this case, looking at a cyclical company, valuing it off free cash flow, I wanted to be super conservative. Although, looking from it's had a bad most recent quarter. It looks like their fourth quarter is always really bad. So it was sort of hard to compare and contrast, but they've had growth, somewhere in the 50% range, um, depending on how you look at it, from what time frames you're looking at it. So we're going to do two models here, but we have, I believe, $153 stock. My low estimate is 188. And then I'm going to do a higher estimate because we've seen, depending on how you measure it, their growth rates on free cash flow seem to be a lot higher than this. But because it's cyclical and there's some different risks involved, I'm going to just put these two growth rate numbers at 10 and 10, increasing the required rate of return to 12 and a half. So my high estimate is 201. And so on this $153 stock, we have a fair value estimate of $194. Now, what I'll say, Morningstar puts the value around 140. The stock's around 150, and I see a value around 190. And so what we're seeing here overall is a really high quality company trading at a cheap valuation with a long track record of free cash flow, paying dividends and things of that nature. And so, that's the review of Penske stock. I hope that you enjoyed it. If you have any feedback for me, leave it in those comments below. I'm Sean. This is not financial advice, and I'll see you on the next one.